jail's not that bad. It's
All views expressed by the hosts and guests in this podcast are solely their opinions and do not reflect the opinions of their respective employers. Guests and hosts may maintain positions in the assets discussed in this podcast. This podcast is for informational purposes only, and nothing in the podcast is intended to be financial, legal, or even life advice.
Editing on the
This guy's telling us to be the typical streamer, but hey, what's up, David? I think is this your first live, or like have you been to like spaces before?
Yeah, I've done spaces a few times. I've been mostly quiet for the last few months just because we've been so busy, but it's starting to, I guess, pick up.
That's good. That's good. Well, I guess while Lambro is preparing all of that, are you actively trading these days?
Only buying the dips, but
yeah,
I guess
only buying
a little
the dips.
too busy. Yeah, a little too busy to
Dude,
do
you're like you're doing that, and you're probably going to be outperforming the majority of people anyway. You know, it's in such a crabby market, so might as well.
Exactly. There's the only thing is just don't be James Wynn, for the summer. Just stick and chill. People are jaded. Trenches are happening. That's why everybody's like saying like, oh yeah, revenue meta, and I'm like, just
okay. My that is such a like. To me, that's so crazy. It's like revenue meta. Like, bro, like, what are we doing if it's not a meta? Like Charlie Munger is rolling in his grave, like after calling us like rat poison. The revenue meta.
I think it's a natural evolution. Everything starts as a money market. Like really focusing on liquidity and infrastructure. And that's like my a 10,000 feet view is just like. We focused on a lot of infrastructure to solve for like these interesting metas, but eventually things have evolved into capital markets where it's not about just trading meaningless stuff. It's about trading things that help scale real businesses that need liquidity. So moving away from trading money for money to capital, the factories, the businesses, the things that actually generate revenue and I mean not revenue, but like a productive asset. That's what really creates an economy, not trading money.
You just went straight to the pitch, man. I love it.
Okay. Yeah. All right. I just tagged you guys on Twitter. Please retweet and amplify the link for the stream a little bit. And then I think we can start.
While we're quote tweeting and like all of that, Coinbase, oh my God, up 43% the past 5 days.
Well, what do you think about short circle long Coinbase?
I mean, I think you should have done that from a couple of days ago.
Yeah, I did look at option pricing, but it was so expensive a few days back. I think it still would have made money. I was just like, I literally don't have that set up on my like Schwab's accounts or whatever, or like this other because I don't trade equities. I never could in my life. It's actually how I found crypto because it was illegal for me to trade equities, debt, or
right, because you were like a banker.
Yeah. It was. I think that's like a fair trade, just like how the deals are struck. But it's just like, I don't know. You go to like you go to like any like a meat space world like event. I went to like a wedding recently, and they were talking about Circle, and they're like, there just is no exposure to the stablecoin narrative, even though everybody's adopting it, and then they just bid it just like a shitcoin, and they're like, wow, this is an incredible technology. Like this is gonna solve U.S. debt theoretically.
We should be looking into like our Wall Street bets. I guess like sentiment days before. I guess like the couple of days before, like a lot of the crypto folks are like very mid curving it, right? Like, oh, here's like the revenue versus like Tether and so on. But yeah, if Circle is worth this much, I think like Tether is like 2 to 3 trillion minimum.
You know what somebody should do is find one of the earlier equity holders of Tether, because there's a lot of them, right? A lot of them actually here in Puerto Rico, and they should launch like a micro strategy using that, or like a wrapper solution with the original equity, and that would be a blowout solution. Just like it would trade at such high premium, and they would get liquidity on like whatever holding assets they have, but.
There you go.
I think a lot of them haven't monetized on the equity layer. It's been mostly just like held through the business. But no, it's I mean, I've actually only bought one stock in my life, which was Coinbase, and that was at 420. So I'm almost break even. This is like when the IPO.
Oh my God.
Yeah, I did it as a meme. And when the IPO, you can list a price, and I just I owned it 420 because it just fuck it. And it actually hit, and I was like, okay, well, fuck, I just bought at the high. yeah,
Yeah.
This
That's
was
pretty
like
cool.
during COVID. Yeah, I was like, oh god, but it happens.
Got it. Okay,
yeah.
I mean, like, I think we can jump right into it because you were talking about COVID. So, Lambro, you want to start or? Yeah.
Yeah, let's go, bro. So what's up? USD.ai. What is that?
I know.
It's a very good name. It's a very good name.
Yeah, don't worry about the product. The name is good enough. Like just deposit, no questions. That took very. If you go to USA.ai, it's listed for 3 million. USD.ai was way cheaper. So we bought that. But USDAI is trying to solve an actual issue in the world using crypto rails. And this issue being how do you finance the AI sector in ways that just is not solvable in traditional finance. In short summary, one of the bigger companies that are public today is CoreWeave. Like CoreWeave can get financing,
Yeah.
right? They are a large company, massive size. They're a hyperscaler, so they can go to Blackstone. They can go to they can go anywhere like KKR, like wherever they want to get money. They can probably structure a loan because their equity is valuable. So they can get a loan, and they can convert it, and they have all these interesting structures. It highly mimics what was happening with like the early Bitcoin mining days. Like, how do you like raise capital for that? And it's really based on not necessarily their collateral, but rather their equity value. Thing is, most of AI and doesn't have large size, like the long tail, effectively. That is, they don't have access to this like easy financing. As a result, like what's happening is that you have this massive long tail, this much bigger than CoreWeave, of these participants that are non-hyperscalers that just don't have access to financing, but they have a very good collateral, right? They have these B200s, they have these brand new chips that are extremely valuable that they have to rent. They have to either rent or they have to buy with cash. It's kind of like imagine buying a house. Like, do you really want to buy a house with cash, or you probably want a mortgage? Do you want to rent? No, you want to own the house. So there's this solution that's missing, which is like, how does anybody get a loan to purchase with debt this really pristine collateral, which is the GPU in itself, probably the most important commodity in the world today. And yeah, we found this out because we were starting to do these loans, and we realized a lot of participants in the long tail just couldn't get any form of access. And we wanted to create a system that was kind of like Aave, where we really didn't care about their FICO score or their background or their equity value or their credit, so to say. And this is not really a credit protocol because credit looks at how much cash flows they make and if they can pay down their debt.
Yeah.
We really try to figure out a way, like, how do you scale this like automobiles, like houses, like airplanes? And they all use a very similar structure, which is kind of like an ABS sort of like, which is an asset-backed security, where you can price the risk. Yeah, and you pull this example up where once you start pricing the risk of like this representation, where it's now like removed from the balance sheet. It's like JP Morgan doesn't hold the loans during a mortgage-backed security. They repackage it and make it tradable. That's how people in the middle of Ohio can get a loan. Before that, you really couldn't buy a house. Like a normal, like Joe Schmo, the American dream didn't really exist. So I guess this is the GPU dream where anybody can buy a GPU with debt. It's the AI dream, so to say, AGI dream. But so that was kind of like what we're doing right now, the end solution. And there's a lot of mechanisms that make it work.
Okay. Drilling into the so basically you enable financing of GPU, which is a yield-bearing asset. But like, as someone that never done any AI farming or any sort of thing, like, would you mind giving me like a brief overview on like how does a GPU work in a yield-bearing asset way? Like, how does the money flow, or what kind of cost or variable that you need to look at?
Yeah, I can just go through the entire stack, and it's a good leasing economy that exists today. There's a massive rental economy. You actually see this with like crypto counterparts too that have made a big dent in the space. And pretty much every single one of these companies used to be ETH miner, including CoreWeave, right? That was their original story. But we can just go through the entire AI stack just to like step back. You have the end customer that's using ChatGPT, that's using like some like image
Folks like us,
generation,
yep.
yeah, and they're paying $20 an hour. I mean $20 a month. So there's like nice cash flows, and they're also getting VC financing to pay their operations. 90% of the OpenAI acquisition was actually in Azure credits and Microsoft like compute credits.
Yeah,
It's like a
yeah.
token acquisition at that point. And 50% of their annual expenses is related to compute.
Yep.
So what happens is they're making money, or they're getting, or they're subsidized by venture financing, and then you go down the ladder where they have to pay the compute owners, and then they either have GPUs themselves, which is like XAI or the OpenAI types, or they rent it out, which both of them also do. So those are the two options. But the thing is, it's a depreciating asset. So most of them don't want to own it. They don't want to use their venture financing. They don't want to sell equity, get cash, and use that cash to buy depreciating assets.
Yeah. Mm-hmm.
It's a very inefficient system. So they usually do renting, like from Amazon or one of these companies. And then that's why there's a rental market. That's because just the way that the underlying asset works. And that's how AI has scaled, just like from these layers. So NVIDIA actually looks at then how do you purchase the GPUs with debt, like with CoreWeave? And then that's the interest rate, right? So this is very similar to the capital stack of a house. What's your mortgage interest rate? And then you own it, and then you rent it out with like Airbnb or like some rental ecosystem, which is trying to beat that mortgage rate. And yeah, the rental rates, if you do an IRR calc, like what is my like annual expense relative to the value of the GPU, it's like 40%. It's very, very expensive, right? But nobody views it like that. They just view it, it's $2 an hour for an H100. Like, oh yeah, it's just like that simple. But if you just annualize that versus the actual value of the
It's a lot
underlying
of money.
asset,
Yeah.
it's a lot of money. It's a lot of money relative to the value. And that's why the interest rates for this typically is in the 15 to 25% APR range, which is very high, even for especially for TradFi. It's just that like they're dealing with like a different risk profile, and usually it's convertibles. A lot of these structures, like whether it's Caruso, whether it's like Lambda, like these emerging neoclouds that people are like hoping for like that big IPO that they give you a loan to convert. It kind of mimics Bitcoin mining loans in the early days, so yeah, they can easily get that capital markets access, but it's all peer to peer. If it's all peer to peer, they only do the big deals. And anybody that's in the space, if you're a big fund, they don't look at 500K deals. They look at the big deals only. This is the basic economies of scale, and it's also why like capital usually serves the big guys. The only times you've ever served the smaller participants, this new AI company that like just got venture financed, they have like $5 to $10 million of equity, and they actually want to own the hardware. Maybe they're a data center, maybe they want to lease it out, maybe they want to do burst pricing because it's a brand new Blackwell series and they don't know what to do with it yet. Yeah, they're not getting a loan. No bank is going to give them a loan. Most private credit funds is too small for them, and if they do talk to one of these participants, it's like a 150-page master loan agreement where it's recourse against the business. So if you default on this, I take your entire business. And crypto has kind of solved this already, right? Like on Aave, they don't care about your FICO score. They don't care about your personal background. They care about your collateral, your pristine, clean collateral. So we created all these steps to make it so that you can borrow against the hardware in of itself, which is very productive, very valuable. It just needs to be separated from the operations so that the capital can be used in a DeFi protocol.
Understood. Just to quickly summarize, because I feel like there's a lot of like to debunk, and there's more people coming in slowly. So like, okay, so basically, there are more than like so there are major players like the biggest. There's different layers of people who requires, let's say, GPU, etc. Most big players can do it themselves, but like a lot of like small startups that have an equity value of like 5 to 10 mil, probably that wants to hold their own hardware wouldn't be able to afford it, and because of the size of the loan or the size of the investment, they probably can't get investment from VC that is not using venture funding but as a loan model as well, and the terms is not great, and that's why there's this created a market gap where crypto been typically solved this by very peer-to-pool model kind of lending.
Yep, exactly. And TradFi, the peer-to-pool, quote unquote, is called an asset-backed security. It's kind of like it's Fannie Mae. It's the Federal National Mortgage Association, right? They literally create the first peer to pool. For them, it's a little more synchronous in that like all the loans are like somewhat similar, and they batch it up, and then they have to resell it. Somebody is appraising all of that at once, kind of like curators on Morpho, right? Like various guys like curating
yeah.
it.
Yeah.
I like how
There-
we're
but there's-
backwards teaching people now.
Yeah,
We were just speed running TradFi, bro. That has always been the case. Yeah.
exactly. But
Yeah.
just like I mean, if you want to speed run it too, there's also Dodd-Frank. It's 2008, or like 2002.
no, please no.
Yeah, yeah. But what happens is that once you start, when you're not aligned, you start packaging up dog shit, right? You're like, oh yeah, I just want
Yeah.
fees, so I'm gonna just put in like the triple A like basket with like
Yeah,
triple
because
Ds.
you get paid for underwriting it, and not because of the upside, right? Like just keep on underwriting it. Yeah.
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 And so that's why they introduced this 5% rule, which is like, hey, you have to put up your own money that loses money first. First loss. We call it FILO in our vaults. We call it FILO vaults, where you have to put up your own money. Otherwise, you don't get a fee, and you also don't like get any yield. And that's how you like align all incentives. In the
Wait,
same
sorry.
way, like
Before explaining the details of why you designed this mechanics, can you just quickly do a walkthrough of the mechanics from, let's say, if I want
High
to
level,
use it,
yeah.
or if I want to,
So yeah, I mean, from a user's perspective, especially a DeFi native audience here, we're creating a synthetic dollar product, which is USDAI. So you just go on our platform, you mint USDAI. That makes no yield. That just gets something we call cores, which is earns points, and then you have staked USDAI, which gets all the yield. If we're not using your money right now, it's in treasury bills. If we are using your money once it's staked, we only use it when it's staked. We're only using 40% of the cash reserves to actually give these infrastructure loans. That's the yield that's being generated. Now we're giving these loans at 20% APR, like each loan on the borrow side. So obviously the yield's very high. Even at 40% utilization, 50% staking rate, it's going to be like 12 to 13% APR. At 80% utilization, which is like much down, we're not doing that anytime soon. That's closer to like 20 to 23. And that's the user interface. Now the architecture, how this all works on the borrow side, to bring that yield, clean it up, abstract it out, and then give it to DeFi. Because somebody has to do that very dirty process of taking all like 100, 200, 400 like loans and then turning it into like a pristine yield to put in Pendle. We are the dirty men. We will do all the very annoying work to make that possible, to abstract it and turn it into a yield-bearing dollar. That's done with really 3 steps for USDAI, and I can describe it very quickly. We have something called Caliber, which is the entry, which is how we tokenize the hardware. We have the FILO, which is how we align at all parties so that it can scale, right? So entry, scale, and then lastly you have the exit, which is the QEV, is a Q extractable value. And those are our 3 pillars in terms of how we scale this underlying protocol. From entry, from just scaling, and then also how you exit. And yeah, I can get into those in a minute. I can explain how they quickly work too, all 3 of them.
yes, please.
So Caliber is an acronym. It's a collateralized asset ledger with insurance, bailment, evaluation, and redemption. It's a lot of steps.
That's a mouthful.
Yeah, it's a mouthful.
You ChatGPT
Yeah.
that, didn't you?
In a little bit, but it was like a lot of things we did to make sure that it was really off balance sheet. And this was inspired by FTX, right? This is inspired by all the other RWAs in the world that have tried to work. We talked to a lot of RWA protocols, and we're like, these all suck. There's some SPV in like the Caymans, and I have money stuck in Bahamas because of FTX, right? Like it took 4 years, and if they go bankrupt, what the fuck are you gonna do? You're waiting 4 years for your money back in a bankruptcy where it's like a pit of vipers where people are fighting for like the last dollar and lawyers are taking fees. The only way around this is effectively, I say off balance sheet, but it's to remove the capital from the operations. And that's the only way you can do this. If it's on the balance sheet of the company, the SPV or this hidden shrouded entity internationally, or even in the US, you can't, in an event of default, in a bankruptcy, you're cooked. Like I said, I still have money in FTX because you're not, or Mt. Gox, right? You have to remove that capital, otherwise it's not part of the fight. Otherwise, it will not be part of the fight because it's not on their balance sheet. So you have to figure out how to separate that out. And in traditional finance, there's something called a sale leaseback, which is very similar to a loan in that they sell it to you and you lease it back, and they have the right to buy back the underlying asset. It's the same thing.
Is that actually like safer, like from from a legal POV when like
It's
somebody's doing diligence? Yeah.
there's equity, junior, mezzanine, senior, and then there's off balance sheet, which is just like it's not
A
even
balance
part of
sheet.
that
Yeah.
formula. Yeah, so it's like it is the most senior in that like it's not even part of the company anymore.
Got
So
it.
it's fully under a single name, and that's why we also insure everything because if it's off balance sheet, it has to be insured, and we ourselves have a master insurance policy that physically insures the hardware. Um, and this is kind of like Athena, how they do off-chain settlement. It's like held in Cefu or like this off
Yeah.
exchange. It's a very similar concept. If you do off exchange, we have off balance sheet. It's a very similar way. Um, and that's how we tokenize. It's like it's not with an SPV. It's not with like a IOU. It's like trust me, bro. It's really separating it out and making it like, hey, this is not even on their balance sheet. And this is how we can create a very highly scalable product in an international domain. Usually for an ABS product like in the US, like you can do those loan structures because you have very good legal rails. But if you do off balance sheet, you can actually do it internationally, like whether in Germany or the US. And then we have Philo, which I explained very briefly before, which is like first loss. If anybody brings in a deal, even though it's good collateral, there's still some stuff that might be a little iffy. Yeah, we just make that whoever brings in a deal has to take first loss. So it's kind of like curators on Morpho. Just imagine that. But there's a little more work because instead of just choosing an oracle, you have to like really look at the underlying collateral. Now we do site visits, right? We do like insurance. We do the separation of assets. There's still some stuff we want to make sure that things are aligned. So yeah, we call Philo vaults skin in the in our company we call skin in the game. Just like, hey, we have to make sure everything's aligned. So we have a curator role. And then lastly, we have something called QEV, which is Q extractable value. It's inspired by Flashbot's MEV boost. For those that don't know, it's like every block on Ethereum, whenever it's minted, there's a little bit MEV. They turn it into an auction so that like everybody gets a small part of that block rewards. And we have the same idea in the event that our protocol is at 100% utilization. In Aave, they have something called like a peg stability module, in that like whenever it goes very high, like obviously it rebalances down because it gets too expensive. That's not really possible in a non-liquidating protocol. We don't liquidate our borrowers ever, and we only make them default. That is so as a result, we invented a new mechanism, which is Q extractable value, in that the hardware depreciates really fast. It's a feature. It's not a bug. In that the loan amortizes faster. So within 3 years, at most, every month you're getting massive amortization, and that's a lot of liquidity that unlocks every month. This was an issue. I can go down the list of every single DeFi protocol that has tried to do this with illiquid assets. It's a very common misconceptions. Oh yeah, it's blue chip, right? It's like U.S. Treasuries, but stuff like usual happens, right? Usual money, they like, oh yeah, it's very blue chip, but then it just depegs, or like look at Anzin, look at like Goldfinch, look at like in early centrifuge pools, right? Doesn't matter how blue chip it is. The only thing that matters is how liquid it is. This stuff, depreciation to me is liquidity. It's like every single month you're getting a lot of cash every single time, and that's how we repeg. QEV is an auction, just like
I was just going to ask about that. Yeah, like if you can speak a bit more in terms of like, let's say if the utilization rate goes to like 80, 90%, like how do you foresee like a scenario if like somebody tried to withdraw like 10% of the pool? Is that going to cause like issues or something like that?
Yeah, they just have to pay enough relative to everyone else. So if it's 10% of the pool, they're a huge part of the pool, and it's really at 100% utilization. If it's at 90, they can actually redeem. And if anybody deposits on top, because our yields are also going to be very high, it's going to be like 25 to 30-ish at that point. Get more depositors, and they can actually redeem whenever it cashes back up. But if it's at 100% utilization and there's no deposits, then it goes into auction. And the auction's a sealed bid, so it's all blind auction. And just put in a bid just like Flashbots. And then depending on how high you bid relative to others, you get majority of liquidity. So if you bid like 100 bips, the next guy does 3, you're getting all of that 3 to 5% a month. So it would take 2 to 3 months.
Okay.
Kind of.
If you don't mind me, let me try to summarize or say it in a way in a crypto like only crypto native way, right? So you have three
This is not
parts.
crypto native enough.
No. Like just in a simplified way, it's also for editing into shorts as well. So the first part is basically you guys phrase all the different kind of like you do all the dirty work to put it into one. You aggregate different loans, I guess, into one loan that generates yield. One of the parts is where basically you have one person that becomes the curator, and he will be the good curator because there's skin in the game, where if it defaults there has a problem. I forgot the first one, with the name of the first one.
Caliber.
Yeah, basically
Yeah.
it's a structured way that makes it safe because it separates everything in terms of like if anything bad happens. And the last part is you use auction mechanism to, let's say, exit the position, even if it's a liquid, people will kind of bid the discount to get away from it. And then because it's a blind bid, that's why it should be okay in some sense.
Yep.
Mechanics
That's a
wise,
very
is that correct?
exactly. That's the architecture of how it all works.
Okay, part two. Let's talk about the assets. Is there anything that we need to be aware of? Let's say, let's say Bitcoin mining course, like supposedly its efficiency, its yield will slowly die out, either by time or potential new model coming out. Is that something that you guys consider, or how do you think about this in terms of GPU and AI?
Just a quick complimentary on top, like if you can speak a bit more about like the if you do any sort of like attestation, like what kind of reporting and so on.
Yeah, so that's actually why we have an insurance standard, in that like it has to be insurable, and insurance has its own standard that's higher than a traditional company, where all the hardware is insured, and that requires site visits. That requires a verification. This is also why we do not do any loans at the purchase. We don't do any loans to businesses. We only do loans against the hardware in of itself. Much like if you don't deposit money into Aave, you can't borrow. For us, it has to be installed in a data center that's a tier 3 at least, so it can be physically verified and checked. And as a result, that's the only thing that's really lendable. And this is kind of an issue because it takes 6 to 8 weeks from the OEM to be delivered to a location. So somebody has to finance that. And we have a partner for that already. But really, we can't finance until it's in the data center, burned in, and actually in the data center. And then it's fortunately for this, it's very easy to track if it's being used or if it's being run, or frankly, all the operational management doesn't really matter to us. That matters to the equity level company. But for us, we're the credit position, right? And we only care about the collateral. So if they're not using it, they're just burning money. It's like you living in your apartment and still paying 8K.
But the valuation of the collateral would move based on performance. Let's say 100 chip 100 right now is worth $1,000, but like because chip 200 comes out, the valuation of the thing, the value of the thing goes down basically.
It certainly does, but in a much more muted way than Bitcoin mining. Bitcoin mining is 100% convexated Bitcoin price. For us, it's very different. Even A100s, like almost a decade now old, it's still very valuable. So the question is like, what is the amortization schedule? What is the depreciation schedule, which is this long, and then what is the amortization schedule, which is shorter? So there's always going to be a buffer. There's a buffer. I can do the math real quick. If it's 100% value, 30% is already haircutted. That's equity cushion. It's like we're only going to give it a 70% loan. 5% is then the first loss of that guy ahead of you who just brought in the loan, and then the amortization is then 65%, and then it's declining really quickly over the next few years. So within a few months is instantly is de-risked, and then within another year it's really de-risked after that point. And that's how we kind of structure all this. Yeah.
Okay.
But to your point about hardware depreciation, there's a huge reason why we designed it as a synthetic dollar. It's like because it depreciates, cash comes really fast because we amortize it faster. It's not balloon payments, it's straight line. And also, this isn't Bitcoin mining. This is the most important commodity in the world. It's it's B200s and these other assets. There's a long line to get it. There's actually a sort of a premium to buy it now. Like people would buy at a premium. So there's massive demand. We have non-crypto participants in our auctions that would buy the stuff like hotcakes, especially at a 30 to 35% discount. they would buy it at 35% discount, and they would resell it at a 5% premium, possibly.
Yeah.
Because it's unlike again, we're the debt position. So if there's issues with the cards, and they can only sell the good cards, right? Then it's actually kind of proven that the underlying assets are very valuable. But yeah.
Two quick follow-ups. Like your like example kind of reminds me of like like the Apollo tokenized private credit funds. A lot of people save at DPEX. A lot of people are just gonna like scoop it in at like a 9 to 10% discount because they kind of looked at it as like a blue chip asset. But my that's more of a comment. Like my question is that you sort of like started by saying a lot of the borrowers are maybe like they might be like a ventures company that's raising 5 to 10 million and then they cannot afford blah blah. It's just for the listeners understanding, is it fair to say that for the larger companies, they are already doing some sort of like these kind of deals, but it's mostly like private credits with like lower yield? And so like essentially like, yes, of course it makes sense because we get the higher yield, like at 80% utilization you would get like 20% and plus and so on. But that's also means like we are like further out like the risk curve, right?
Yeah. Again, it's a question of what credit is. And they're actually the same interest rates. They're still very high for like CoreWeave. I think it was like SOFR plus 11.5, which is 16-17% APR. So like even the big guys are paying a decent amount. As for the risk curve, like I said, if it's really just against the collateral, like what exactly is risk and credit
Right.
Versus like the collateral in of itself?
Because it's not the company. Yeah.
Yeah, it's not really the company. So the company no longer matters. It's a small part of it, certainly. We don't want too much volume in secondary markets. We want them to repay, and like we don't want to have this defeasance is the phrasing, where they repay early, or like we just want them to pay the interest. But in terms of yes, it seemed is viewed as high risk. It's kind of like the narrative arbitrage. It's like yeah, it's actually not. Like they're viewing it the wrong way. They're viewing it like a cash flow business when in reality it's a hardware business.
Got it.
Yeah. That's the core difference. And it's also why we don't extend any form of business loans. We will never do a loan against a business. We do a loan against ourselves, which is hardware.
Understood.
Makes sense.
Okay, I think.
All right, Lambro. Like, what's your take so far?
I mean, yeah, it makes sense. Everything makes sense. It's the mechanics wise, everything cool. All right, so sorry. How do we farm it? What are some actionables? How are we farming it? Points, all those kind of stuff. Can you? I know you have
Bless
a
you,
coin
sir.
like 5 to 10 minutes, so like let's squeeze these out real quick.
Yeah. So right now we're in our trial period. Like I said, it takes 6 weeks to burn in the location. So we're actually just doing all fresh new collateral as like our initial borrowers. We have like a data center. Like these are companies that have never even touched crypto that are now borrowing. So our off ramps are loving us because they're like you found a sector that like suddenly uses crypto. But we have this like private deposit program that's not really private. It's more like trial. There's no points being rewarded there. We will have points that's very similar to like Athena's. Unstaked gets more points in the staked version. If it's like I said, if it's not unstaked, it's just in T-bills. And yeah, we'll probably do all the things that you're familiar with. Once there's a synthetic dollar, then we have the LP markets, which earns rewards, and then you have the looping. You just go down the road of all of these other things.
With the PTYTs and so on. Yeah.
Yeah. Our backend's on Arbitrum, kind of like USDD0. It's just like, for me, we do have a lot of on-chain like transactions because we're a fully on-chain native protocol. To your point about Apollo, like cred and acred, sorry, acred and sacred, we are entirely on-chain. We don't securitize or trust a third party off-chain. Like I know a lot of people do this.
That's a good
differentiation.
Tokenizing
securities. That's because I think it's a huge risk. Yes, they get the nice brand, but what if Apollo changes fees like overnight?
Yeah.
They're like Apollo wants more. There's a value supply chain, and there's gaps of like, hey, who gets all the rewards? They start low, and then Apollo's like, hey, we control the entire supply chain. We're just gonna take all the fees. We can't do anything
because you're trusting the.
So we really create this instrument. Yeah, everything's on chain. So once the sale leaseback happens off chain, we can structure all the yield and we control the entire fee structure. So that's one thing that's nice about this design. It's like we're really using everything crypto natively while we're solving a real world issue, which is that the long tail cannot get financed, even though they're quite creditworthy.
Got it.
So how to farm it? Yeah, like I said, it's going to be the usual structure. When it
Are
comes
you
to
guys
DeFi.
launched yet? By the way, sorry.
We are not. We're currently targeting mid-July for public launch because that's when the loans start coming in and the yields become very high. But right now our yields it's just stale capital. We're just waiting for those the burn-in installation. So there's quite a bit of lag in terms of like, hey, if a lot more cash comes in, then the yields have to pick up. In the meanwhile, we do have points to compensate for that delta, where people are like, hey, well, my money is not 100%, for at least 40% utilized. And I'm like, well, you get something else for being the early capital.
Got it.
Nice, got it. Yeah.
I know we just want to be cautious of time, but like what maybe like the last question before the last question is sort of like what made you decide on this crazy idea?
Yeah, we were actually operating another entity out of Abu Dhabi, in ADGM, trying to mine these different AI networks, Aether and IONET. It was called Tactical Compute or TACOM. And I was literally in the data center, like it's very, very, very loud in the data center, by the way. There's even showers in the data center. It's like, oh yeah, people just literally live here. And I guess what were the two best things or three best things that crypto has done? First, it was stablecoins. That's a narrative, right? Incredible technology. Then there's exchanges, which Athena kind of combined both, right? You unlocked the perps yield, which was foreign to anybody outside of crypto. They're like, what the hell is perps yield? Why is there like a premium? Why is it like paying 30%? Now it's like steady down because it's a money markets. It gets ARPed out, like guaranteed. But what the first and best use case of crypto is scaled hardware. Like really AI wouldn't have existed unless unless Ethereum built out these massive like GPU operations. Like NVIDIA was a crypto stock at one point, if we all remember. And then obviously proof of stake happened and their stock crashed. But all the CoreWeave literally was an ETH miner, and like it was all these massive build outs. It's effectively DeFi. And Bitcoin mining again, 25 to $50 billion of debt, because the greatest subsidy is like that 20, 30 billion of rewards you get up Bitcoin every year, and that's like the yield farm. It's like that was the original yield farm.
Yeah, the original yield farm.
So Athena combines stablecoins and exchanges, which were the two other great businesses. We're doing hardware and stablecoins, which I think is the other side of the crypto native RWAs. And it was just like a really big need. Like to my point earlier, Marco, about where I think the market's going, it goes from a money markets where it focuses on trading things that are made to be traded to capital markets, which are supporting economies that are actually productive. And they don't care about their shape or form. They care about being a tractor or a business that scales and makes money that is actually doing something in the market that's productive. It's like that's why we always use an example of a forklift or a tractor. Like it's actually making fruits from a farm, and that economy has not existed. All of DeFi today is money markets, and I'm like, money markets inherently are unproductive. And if you told me you work in money markets and an investment bank, you don't get invited to drinks after work. You're like, oh yeah, are you giving loans against Apple stock? Like sick. I gotta go, like I gotta go, like actually do something with my life. That's how they're treated because, like, what are you doing for the world? You're just giving liquidity against the Apple stock, right? Versus like, hey, let's give a loan to a business to help build a new factory somewhere in order to scale. That's like the original purpose of the capital markets.
The entire financial markets, pretty much. Yeah.
So everybody says internet capital markets. I'm like, that's an oxymoron. Like, there's internet capital. There is internet capital out there, but everything in crypto is not capital. It's money, where there is capital, and this is right before us. It's not like it's not bringing RWAs on chain, which generally I don't believe in RWA, the thesis in of itself. I think it's very flawed. I think you have adverse selection left and right, especially if you're tokenizing securities, which is by definition an asset that already has a very efficient capital markets. And I'm like, why bring it on chains? Because it's dog shit. You think a 50 to $100 billion market matters in the TradFi world? That's like one credit fund. Like,
Yeah,
oh
yeah.
wow, like it's not that liquid. Versus let's take something in crypto that's massive and bring it to TradFi. We should be dumping on them, not the other way around. They are the bigger market. So it's that's kind of what got me excited.
Got
And
it.
it's always been our thesis. Our previous company was called MetaStreet, which was again dealing with like low liquidity assets. It's just that we haven't really found something on chain. We're looking at like NFTs and like Axes and other RWAs, but none of those really hit. Like, if you were to do computer science metaphor, it's like you have functions based, which is really what Aave is, right? If it doesn't fit into the function,
Yeah.
if it doesn't have an oracle, it doesn't fit. Versus object oriented, which is like, hey, look at the object, and if it's productive, let's build the systems around that. So we found hardware. We're like, hey, how do we unlock this capex, which is a great form
Yeah,
of yield?
yeah. Makes
Yeah.
sense.
So that was kind of
Okay.
like the inspiration of our discovery process defining the sector. And for us, I think this is the most important capex in the world. And instead of buying, other synthetic dollars, which is financing the U.S. government, which is T-bills, why don't you finance AGI and the future of AI? It doesn't have to be T-bills. Yes, there's a little more risk for financing AI, but at the same time, it's a much better story than just being extra liquidity for the U.S. government.
There you go. I love it, dude. I don't know if I'm biased because I like what you're doing, but I think you're like explaining a tough concept in a pretty solid way. Like I've heard other founders trying to explain shit in much more simple but much more complicated.
I still think I'm somewhat complicated, so it's I'm working on it in terms of telling the story. I've been trying to think of more metaphors. I'm like, hey, if oil is the most important dollar and the petrodollar, the next thing's AI dollar. It's like,
There you go.
and you look at the commodities of the world, it's going to be compute. But yeah, I'm just trying to contextualize it to like, hey, how does crypto actually affect the world today? And I'm like, it's not with what we have and what we're marketing on Twitter. It's really great technology. It's just I think it just has been used incorrectly.
Got it.
Nice.
All right, bro.
It was very compact. I learned quite a bit of things in terms of the AI GPU market as well. I think I'll pick your brain a little bit more after this session. But yeah, there's a last question that we'll ask everyone that comes on here. What do you think is required to make it in crypto?
Patience, without a doubt. So it's a very fast market. I think everybody's in the get rich quick business. But in that when everybody's doing the same strategy, it is usually just being a lot more thoughtful and convicted in what you actually believe in, and then betting your bags on that. I think you've seen that with Hyperliquid. A lot of people were very patient with it. I didn't have a bag, but I have respect for people for believing in that business and just like kind of holding it through. And those people outperform most of the people in the trenches. So
100%.
It is patience. I mean, I myself have patience. I've been in the industry for a little too long. I've been building this business for also a long period. But it was just this process of discovery, grit, survivability, but also just not getting jaded. Like I said, don't be James Wynn. Like, don't get tilted to the center. Don't be in the trenches and like have PTSD from World War One. It's just like, I think it's very short-sighted. Everybody goes through a process, even myself. In the first bear market you go through, you're like, damn, should I still be in this industry? I kind of gave up. Yeah, I was looking for like TradFi jobs. But once you survive that, you really become like, a veteran. And in terms of quote making it, that's certainly nice. But it's just being like a industry participant is very rewarding. So yeah, just being patient, surviving. People say that. I think people haven't really dug into what that meant. One is just the campaign we're about to launch is called Stake and Chill as a foil to James Wynn, like fail to the trenches. Like, hey, there is ways to really realize, and I think we're seeing that in the world today. Like, this is the post 2002, 2001, right? You saw like the big boom of interest in crypto because it was get rich fast. But then in 2003, for tech industry, people actually started using technology. Now, stablecoins are taking off because people are actually starting to use technology to start to really appreciate it. So we're about to enter that growth stage of like 2003 to 2025 for tech, which
Bro, you would make a very good VC, man.
yeah. So it's
No,
just
but I do agree.
like people are actually understanding like this is really useful. We're a lot of our borrowers that are onboarding that have never touched crypto. It's under like Coinbase Prime. They're like, what's a wallet? They're like, wait, we can get this loan now today? Like, and I'm like, yeah, you can. If it's in a data center, you can tokenize it, borrow against it, and the tether's in your wallet by that time, and then you're off ramped the next day. They're like, this is. I thought we had to go through a wired and there's Forex and all those other things. They're like, no, it's instant.
I can hate wired. Yeah.
No, wiring's miserable. Like, if I invest in a company and they say like, can you wire? I'm like, I'm out. Not for me. Just USDC, USDT only. But I think it's we're seeing the greatest macro event in history for crypto, and people are just getting jaded right now. And I'm like, guys, like, you don't see what's going on in the world. Like, people are. TradFi is finally coming. Like, the Novo meme, like, yeah, the banks are coming. I'm like, they're actually coming now. You go to like Bitcoin Vegas, I was there, like, talk to any banker, and you should ask them, like, what are they doing outside of crypto? Nothing. They're that's like, what other deals are you guys working on? What other verticals? Industrials, financial sponsors, like all these other sectors, real estate, like, no. It's just crypto, man. Like, that's all that's happening in the market. So people are here and people are interested. People talk about AI, but I don't. Outside of, it's mostly crypto stocks that are getting listed and IPOing. It's not AI companies. AI companies getting bought by like Meta and stuff like that, but they're not launching into the public. And I think it's a little dangerous, just like how many rappers there are. But it's a game of musical chairs, very unproductive businesses. It does open up some exposure. I did the grayscale trade, so I'm very biased against public market equities and wrapping things that are very easy to get exposure to. Anyways, that's another conversation to have.
No, but yeah, that's great, man. Yeah.
Overstaying my time here, but it's
No.
This is great,
I thought you I enjoyed this. I think we should come, if you have time, we should come on and have like casual chats on other things a little bit more as well.
Yeah, even like a lot of other topics. But yeah, like this is I think this is good. So just to quickly recap, any shout outs for the like listeners and so on? Like, I guess like look forward to your launch date sometime in July and so on.
Yeah. I always like to give shout outs to other companies that I've liked in the space. Just like people like good visions. There's two companies, the Good Brothers, that I've liked like just chatting with and like intellectualizing with. One is called Post Fiat, it's by Good Alexander. He's kind of like the leader of like AI thought. And he's done a really good job not shilling new dog shit coins, which a lot of AI influencers have, AI coin influencers. Yes, he shills XRP, but with a very good thesis, certainly. But I think Post Fiat is like just, he's launching the Doom ETF. Like, it's very thoughtful about what he's actually trying to launch, and he's a long-term builder. And its other brother, Travis Goody, is working on Ambient XYZ. It's another like AI coin, but really thoughtful about utilization of underlying assets. I think there's a big the decentralized AI thesis of like, hey, let's have all this decentralized training or inference. I think is a bit of a trap. You're seeing a lot of these companies do it, but obviously we've tried this many times before and talked to a lot of experts, and they're very doubtful. But Ambient's actually more thinking about utilization. So both those companies are very not only did they have great backers and like great ideas, but it's great operators. Another company in my sector, which is like more, I call it InfraFi, not DePen. I think it's to me, equipment should not be at all equity finance, and to me, token issuance is equity financing. Certainly a good use case, but the real business is debt. Like, and most importantly, I didn't even get to this, but like, all equipment financing in the U.S. is a tax play. It's not a yield play. If you guys want to talk about crypto tax, especially with this big bill with Trump versus Elon, there's a very important thing in the one big beautiful bill called bonus depreciation. Jeb Caleb did this, right, and founded Ripple. He bought a fuck ton of GPUs with this nonprofit to offset his XRP sales. Anyways,
God.
That's another thing. Yeah. It's just like, hey, but There's another company that does this really well. It's called Daylight. It's founded by
Daylight, yeah.
Jason. Yeah, and
Yeah.
he's also like a really good operator. Also private equity background, just like my other co-founder. So it's really thoughtful. But he's like really thinking about the tax structuring for his product. And he's actually thinking about solving a real world problem with the solution.
Yeah. Yeah.
Along with like I think Dawn is also a very good product in terms of being a real world operator. That's more on the defense side, or sorry, InfraFi. And then on the AI side, yeah, Alex Good and Travis Good. Those are like 4 companies I really like. As for DeFi, I mean, DeFi is already well covered. It's just like these are the new companies to me that are quite exciting and very thoughtful about where crypto can actually be useful in scaling these kind of operations. That's my real world value pitch in terms of things that people can look at for like. And by the way, like RWA platforms, like everything's RWA, right? Like kind of like, oh yeah, DeFi platforms, like everything's financial. So RWA platforms to me is like a little iffy of a pitch. To me, Athena is an RWA, but they don't say they're an RWA. Like you're taking a C DeFi, that's RWA.
Yeah. Yeah.
So I would just caution this, the siren of like, hey, we're an RWA platform. Like, I mean, everything is.
Yeah, like, we need better terms in crypto. Like, I'm just glad that we are way past the DeFi AI. Like DeFi, whatever that.
Yeah.
But
Yeah.
But yeah.
So, I recommend those guys to follow. Along with ours, we're USDAI_official.
There you go.
But yeah,
Awesome.
if users want to like check us out in terms of what we're building and trying to solve a real problem and bring the entire stack on chain, we'll probably be launching in mid-July. We're in a trial period. No points have been awarded to those early depositors. They're really there for like bridge liquidity to get the yields up. But yeah, that's how I'll close it.
All right. Thanks,
All
man.
right.
Like I know
you,
that you're going to
guys.
jump off. So like again, thanks for squeezing some time. And until next time.
Great. It's a pleasure, guys. Catch you later.
Cheers.